Over the past week or so, publicly traded companies have been slowly releasing their Q2 earnings, and investors have been waiting extremely patiently to get their hands on these financial documents to see the depth of the financial damage that has arisen from business shutdowns across North America during the first half of 2020. Well, the numbers for Q2 are in, and in today's video, we're going to be revisiting one of the largest and most popular Canadian real estate investment trusts, which is RioCan, and this is a REIT that I did make a Q1 earnings analysis video on, really well received by the audience, and you all really seem to enjoy the content in that video. So today we're going to be seeing how this retail focused real estate investment trust has fared during this most difficult operating period in its history. In contrast to REITs that focus on industrial and residential real estate such as Granite REIT and Northview Apartment REIT, which have both rebounded quite nicely since March lows, RioCan hasn't really followed suit, as the state of brick and mortar retail properties is still quite rocky, and it really exposes the true competition right now more than ever of online business. Hey, what's going on, savers and investors? I hope you're all having a great day as always. If you're new to the channel, then welcome. My name is Griffin, and in today's video, we're going to be conducting a follow-up video to my Q1 earnings analysis of RioCan, since Q2 has just been released, and people are now wondering, well, is RioCan still a good long-term buy and hold stock for both dividend income and potentially long-term appreciation based on where the stock price is currently at? The impacts of the medical issue have been extremely difficult for companies of all sizes, especially for companies operating in the retail, restaurant, and travel industries, with small to medium businesses shutting down on a wide-scale level across North America, and even having an impact on larger retailers that have been around for decades. Now, obviously, this has a direct impact on RioCan's operations because their bread and butter happens to be retail-focused real estate, where they lease out their properties to a variety of different tenants that actually sell physical goods or do things in person. For example, grocery stores, restaurants, clothing retailers, banks, and the list goes on. And unfortunately, since our Q1 earnings analysis video of RioCan a couple months back, there have been a handful of their tenants that unfortunately have filed for bankruptcy and are now in a position where they're not able to pay RioCan their rent that is due. So we're going to see how this has impacted their revenues when looking at their income statement shortly. We'll be speaking about some of RioCan's specific tenants and subsequently their rental income, as well as covering how this company is coping during this unprecedented market period for brick and mortar business. Now, if at any point in today's video you enjoy the content and it provides you value, please just take 2 seconds to drop a like on this video. It really helps the channel grow and tells me that you enjoy this type of content. Also, if you're still looking to open up a brokerage account so that you can start trading stocks, real estate investment trusts, and ETFs, then make sure to check out one of the 2 links down in the description to open either a Wealthsimple Trade or a Questrade account. And when you open an account through one of those 2 links, you will get some free money just for doing so. Alright, so with all that said, let's first take a look at the current stock quote and chart of RioCan, which has the ticker symbol REI.UN, with the UN due to the fact that it is a trust. From its peak in February, the stock quickly dropped by roughly 55% and then recovered slightly to a point where it's now been trading sideways and remains down around 46% to this day. This stock trend is mainly attributed to investor outlook on both the retail industry as a whole and the tenants RioCan is leasing to, with anticipations for Q2 earnings not being all too positive. Considering that we now have access to Q2 earnings and the price per share has remained basically the same since my last video, down 46%, we'll be speaking about whether or not this is justified and if getting in at this price point is something to consider for both high dividend income and nice share appreciation once revenues and operations are back to scale and investor confidence has returned. Now, in my previous video titled Are REITs Doomed?, going over a comparison of 6 different Canadian REITs operating in different facets of real estate. By the way, I highly recommend that you watch it because it puts 6 of the most well-recognized Canadian REITs head-to-head regarding their financials. Well, Morningstar had forecasted annual revenue growth for RioCan at a loss of 7.9% in the 2020 year, mostly attributed to the fact that this REIT operates in the retail sector and that most likely, depending on the severity of the medical issue and period of time that stores would be closed, tenant income would be highly truncated. Let's remember that although a REIT can sell some of their assets to generate income, the main goal and obligation of a REIT is to own and operate income-generating real estate that they rent out to tenants and then collect rent for doing so. So in the event that some of RioCan's tenants had a weak balance sheet entering this mass business shutdown, there was a high possibility that some of these businesses wouldn't have the liquidities to make it out to the other side, resulting in bankruptcy and, in the case of RioCan's interest, missed rental payments. To summarize how the trust was operating at the end of 2019 and entering 2020, throughout Q1, RioCan had high revenue collection rates from their tenants in the 98% range and great FFO per share figures, which is basically basically earnings per share for a REIT, which made it one of Canada's most stable real estate investment trusts with a great dividend distribution for an investor's portfolio. The largest issue at the forefront of investors' minds regarding this REIT was really just their exposure to brick and mortar retail locations for reasons we just discussed. Now that we have Q2 earnings and balance sheet figures though, we can at least have somewhat of a better idea of how the company is adjusting from a financial standpoint through this unprecedented period and what their outlook is moving forward. In the case of RioCan, the Q2 financial statement and letter to shareholders was released a couple of days ago on July 29th, and I've had the chance to go through it and come up with some conclusions on where I think the REIT stands since my conclusion on it after Q1. We'll mainly be running through the revenues, the funds from operations, net operating income, balance sheet strength, and forward-looking information, but before that, let's cover what the CEO and board of directors have spoken about to shareholders and get a sense of how the company has shifted their focus since the first quarter of 2020. In the previous Q1 earnings analysis video that I conducted on RioCan, I started the video off by doing a brief overview of the letter from the CEO, Edward Sunshine, which had a very different tone and subject matter than this one for Q2. While the Q1 letter from the CEO spoke more about how RioCan was in a position of anticipation and preparation for this type of black swan event, with revenues and other metrics mainly untouched, this new letter to unit holders is more focused on how they're assisting their tenants and helping them navigate through rough waters, with an incline towards how the trust's size and liquidity has been paramount in maintaining operations. Rent collection has been difficult for certain tenants but should be stabilized by the end of the year. Following these opening statements, the main body of this letter interestingly addresses consumer behavior shifts towards e-commerce, which has been accelerated by the global medical situation and will now grow at a much quicker pace as a result. This has an impact on RioCan because their business is renting out their properties to physical stores and retailers. To combat this, RioCan has concentrated their portfolio in the fastest growing regions in Canada to maintain high levels of foot traffic in their physical complexes, and is attempting to shift towards the convenience of open air shopping experiences and incorporating residential real estate into their global plan moving forward. Now, from the tone and subject matter chosen in this letter, what I honestly get out of this is that RioCan didn't necessarily anticipate the medical situation to last as long as it did and have such a devastating effect on some of their tenants, because had stores opened back up shortly after the end of Q1, we wouldn't be in the same position. What we have just experienced with the illness pretty much accelerated the growth shift from retail to online, and unfortunately, a good chunk of RioCan's tenants were non-essential businesses, meaning they didn't have a choice but to shut down for several months. Luckily, RioCan does have a diverse client mix to hedge against this type of situation that we're going to be speaking about later, but this letter to unit holders definitely has a much more defensive tone to it in relation to Q1, which was very confident. Finally, for those interested in RioCan's dividend distributions, it's been said that given recent trends in Canada and unforeseen circumstances, RioCan does remain comfortable with their current distributions, which as of now are just under a 10% dividend yield. To summarize, this document touches dozens of elements about the trust and their outlook, but I find this paragraph clearly explains RioCan's current position. Despite the gradual resumption in economic activities in the second half of 2020, the Canadian economy is expected to contract in 2020 as the recovery is expected to be slow. The trust expects 2020 to be impacted negatively by the pandemic and estimates FFO per unit to be in the $1.60 range for the year. Similarly, the trust expects same property NOI growth to be negative for 2020. To put this in perspective, the FFO in 2019 of RioCan was $1.87 per unit, so at a forecasted $1.60 FFO per share for 2020, this is a reduction in funds from operations of 14.4%. The current stock price being down still 45% is still quite harsh in my opinion regarding the future outlook of the fund. Alright, so moving on now, just as we did in the previous Q1 video, another important factor to look at in order to pre-frame all the financial numbers we're about to speak of is RioCan's real estate portfolio key facts, because this gives some tremendous insight into the trust's portfolio and how it's changed since the previous quarter, as a handful of their tenants have filed for bankruptcy and will therefore not continue paying RioCan rent. First of all, let's bring our attention to this row right here, where the occupancy rate of their total portfolio, including retail and office, is currently at 96%. 96.4% occupied as of June 30th, 2020, which accounts for 206 properties and is down slightly from the previous quarter, where the total occupancy was at 96.8%. This may not seem like a lot from a percentage standpoint, but in terms of net leasable square feet, this actually represents just around 150,000 square feet of property, which is somewhat substantial and will make a dent in their revenues for sure. Now, one of RioCan's most important factors contributing to long-term success and stability in rental revenues has been their tenant diversity in both geographic areas and tenant industries. Prior to Q2 earnings figures, no tenant accounted for more than 5% of RioCan's total revenues, limiting their revenue exposure to each individual company, which is definitely positive from a risk mitigation standpoint. Since the last earnings report, however, the percentage of annualized rental revenue has changed slightly in that the top 10 now represent higher portions of RioCan's annual revenue figures. What this really means is that as certain tenants are defaulting on or deferring rent payments, RioCan's tenant mix has slightly shrunk and each current tenant represents a higher percentage of total rental revenues. The way I personally see this is that as time goes on, RioCan won't have a choice but to strategically offload certain types of retail properties to focus on properties that can accommodate essential businesses such as pharmacies, grocery stores, and certain retailers like Canadian Tire, rather than mall-style properties that host smaller retailers like clothing and specialty stores that we're shifting away from as a society. In addition to this, it will be paramount for RioCan to start also focusing more on their residential projects as the Canadian population continues to grow and there will always be a demand for this type of residential real estate. With that said, even though there has been a slight shift in RioCan's revenues, the retail portfolio remains somewhat attractive from a tenant standpoint because, just as I had predicted and mentioned previously, it is quite resilient to market cycles, with most of their tenants being essential businesses that will continue serving customers and be in a position to pay rent, with 75.2% of rent collected being from these necessity-based service-oriented tenants. Some of these essential tenants include Loblaws, Sobeys, Rexall, LCBO, Metro, Petro-Canada, and the list goes on. It's also made very clear in this document that RioCan is working towards building a tenant mixture that is forward-looking and market cycle resilient. This is what the company has stated on page 34, where they've indicated that RioCan is well aware that the Canadian retail environment has been evolving. The trust is adapting to the ever-changing retail landscape and incorporates future trends and growth patterns in its strategy and operations. The trust has also been increasing its major market focus while evolving its tenant mix to better suit community needs, make its tenant mix more resilient to the impact of e-commerce, and increase the growth profile of its portfolio. This type of company outlook and awareness about the market they are serving is exactly what is needed from a real estate investment trust that currently focuses mainly on brick and mortar retail. With that said, even though the trust acknowledges this and is looking to further diversify into residential and office real estate, the reality remains that the future market value of their retail properties, meaning most of their assets right now, will be impacted as we continue to shift away from brick and mortar retail. Luckily, a lot of their tenants include grocery stores, pharmacies, and restaurants, which will remain useful and attractive to the general public, unlike a clothing store that would have no issue going 100% online. Finally, an interesting point to note is that the average net rent per square foot has increased over the past 3 and 6 months when compared to same periods last year, meaning they are able to charge more for new leases. I really hope you're enjoying the depth of this analysis so far. If you are, please make sure to like this video. It really helps the channel grow and tells me that you're enjoying this type of content. Let's now speak about rent collection over the past 3 months, which is what I was most anticipating in this earnings report, since missed rent payments was what would have had the most devastating impact on a REIT. And again, some of RioCan's tenants did unfortunately have to file Chapter 11, meaning restructuring filings or even bankruptcy. This table demonstrates the collection of billed gross rents for the second quarter as of July 28, 2020. Cash collections, meaning fully paid, is at 73.3% and government funding is at 5.8%. Over the course of Q2, 7.7% of total rents have been deferred and 6.4% of rents are remaining to be collected, both of which RioCan is confident in the collectability. This essentially leaves 6.8% of Q2 rents that RioCan has basically written off as rent abatements or bad debts, meaning they won't be collecting this portion of rental revenues and have accepted it. To be honest, this isn't great, but considering the scale of brick and mortar business shutdowns over Q2, this isn't really as bad as many were expecting, and the current share price just reflects a much worse scenario in my opinion. Nonetheless, in contrast to Q1 where rent collection was practically untouched in the 98% of rent collection range, this is substantial and will be reflected in the income statement that we'll be looking at shortly. If we look at this table located on page 33, this includes all of RioCan's tenants that have filed for restructuring since March 31st and therefore have been problem tenants from a rent collection standpoint. These tenants include Reitmans, Global Shoes, GNC, and then others such as David's Tea, Lucky Brand, J. Crew, etc. Mostly all clothing retailers that were obligated to be closed for excess periods of time since they weren't deemed necessary businesses. In total, these tenants account for 1.7% of RioCan's current annualized rental revenues. Alright, so now that we've had a chance to speak about the current issues surrounding RioCan, let's actually take a look at their second quarter 2020 income statement comparing this period to same period last year. As to be expected, figures are down across this entire income statement. Starting with the revenues for the second quarter of this year, we have $269 million, which is down by $57.7 million or 17.6% since same quarter last year. This might seem like a really striking difference between both quarters, but in reality, this is due to the fact that in Q2 2019, the trust offloaded some properties in the waters of $47 million, which was added to their total revenues for the quarter. When we just look at the rental revenues, which is the true lifeblood of a REIT, revenues are only down by $7.9 million or 2.9%, which is seemingly a lot less. Now, in terms of the net loss, this looks like a complete disaster at a $350.77 million loss. Where did this come from and why is it so substantial? Over the same quarter of 2019, the net income was $253 million, representing a decrease of $604 million in this quarter. Again, this figure is somewhat skewed because the majority of this net loss is attributed to a paper decrease in the fair value of their buildings. If this is the first time you hear of this concept, let me explain. A fair market value gain or loss refers to the changes in the current fair market value of the assets and liabilities of a company. In the case of RioCan, this constitutes the fair market value of their pieces of real estate that have declined due to the medical situation having an impact on the value of retail real estate. So this is simply an accounting paper loss, and the trust hasn't actually seen a $350 million net loss for the quarter if we hadn't taken that into account. This is similar to if each quarter you were to estimate the value of your house and then add that to your personal income statement. When excluding the $573 million in net fair value losses over the comparable quarter, net income for Q2 2020 was $100.9 million, representing a decrease of 27.9%, which is still quite large, but nonetheless, this is not nearly as much as a $650 million difference. With that said, if you've been around the channel for a while, then you would know that when assessing a REIT, a more accurate and relevant metric of their financial viability is the funds from operations, or FFO for short. The FFO is a true sign of the financial health or stability of a REIT, as it takes into account revenues, depreciation, and amortization, and then subtracts any gains from sale of property, which is much more indicative of the cash flow for a REIT. Let's take a look at the funds from operations section on page 24, because this is really what's most telling for the financial viability and performance of a REIT. We start with the net income of negative $350 million, but add back to that the fair value loss of $451 million, because this doesn't have an impact on actual cash flow, as well as a variety of other elements, for a total FFO of $109.9 million in Q2 2020, which is down $34.8 million or 24% since same quarter last year. On a diluted per unit basis, this represents a 35-cent decrease because the trust has also issued out more shares to raise capital in order to bolster their liquidity during this uncertain time. I'd also like to bring your attention to the fact that the FFO payout ratio, which is the trust's dividend payout ratio related to the funds from operations rather than net income for a typical company, because remember here, FFO is much more relevant for a REIT, it is now 83.2% in the 6 months ended June 30th, which is up 6%, bringing it above the fund's target of 80% or less. So while this is somewhat high, the fund has mentioned that the monthly dividend distributions should remain intact for now and in the foreseeable future. With all that covered, I know it's a lot of information to take in, but we're now going to be diving into the balance sheet to see what we're dealing with from an actual financial standpoint. And if you're enjoying this video and it's providing you value, please take 2 seconds to like the video. It really helps justify all the time and analysis that I put into each one of these videos. Diving now into RioCan's balance sheet for the second quarter of 2020, the trust has actually seen a decline in total assets by roughly $118 million. This is mainly attributed to the fair market value of their investment properties and a decline in cash and cash equivalents. With that said, other elements of their balance sheet have been on the rise, such as mortgages and loans receivable, as well as residential inventory and other receivables, which is mainly rent owed from tenants. Moving on to the liabilities section, as to be expected, this has increased since the company has taken on debt to maintain operations. Debentures payable have increased by roughly $200 million, while accounts payable have also increased as they have deferred certain payments. However, with the nature of real estate, these types of companies typically carry higher levels of acceptable debt than a typical company in the form of mortgages, because this is a staple financing activity for all real estate operations. All this to say that as of Q2 2020, the debt to total assets ratio for RioCan is 48%, which might sound high, but is actually quite low compared to most other REITs in Canada. Overall, this balance sheet is actually quite acceptable, and considering what RioCan just went through, I agree with their dozens of mentions throughout this whole document that the trust is focusing on maintaining a strong and healthy balance sheet. Finally, what I'd like to speak about briefly is RioCan's liquidity, which as of June 30th sits at $1 billion, mostly in undrawn revolving unsecured operating lines of credit. We can really see the company's focus on bolstering and maintaining liquidity for any unforeseen events. This translates over to a higher liquidity percentage of total contractual debt. Now that we have a better idea of RioCan's income statement, balance sheet, and operations during the second quarter of 2020, what are my final thoughts on the company as it currently stands right now? Obviously, there's a lot more information that we could have covered in this earnings analysis video. However, I really just tried to boil it down as best as I could to the most relevant information, even though this video is quite lengthy. So for starters, things have changed in RioCan's tenant mix since Q1, where things were practically untouched at that point. Due to the fact that business closures extended pretty much throughout the entirety of Q2, this pushed some of RioCan's tenants into tough financial situations, which resulted in defaulting on rent payments. All things considered, as of right now, this represents around 6.5% of RioCan's rental revenue for Q2, which has not been collected and will most likely just be defaulted on, which is somewhat substantial. However, could have been much worse considering the whole situation, and Q2 is most likely going to be the most devastating period for RioCan due to the fact that now most of the businesses that they are leasing to are up and running. The fact that a high percentage of their tenants are considered to be essential businesses and therefore were allowed to remain open during the entirety of Q2 definitely played to their advantage here, and it's made very clear by management throughout this entire document that in the future they're going to be focusing on trying to acquire a higher percentage of tenants that are deemed essential businesses in order to combat this type of situation if it were to happen in the future. In fact, the companies also mentioned throughout this document that they're in the process of building a variety of properties right now, and in the future they're going to be focusing on acquiring and building more residential properties, which I personally think is a great strategy because residential real estate is obviously here to stay and is going to have an increase in demand as the population of Canada continues to expand, and basically everyone just needs a place to live. The second point I want to mention is that even though the company is seeing an increasing trend of their tenants getting back on their feet and up and running, the reality remains that for a handful of their smaller shops and retailers that they're leasing to, this currently represents 1.5 million square feet of real estate that is not currently generating revenue and might not be generating a revenue in the future if they're unable to release out those spaces to new tenants. Basically, what I'm trying to say here is that a certain percentage of RioCan's tenants have since filed for bankruptcy, and for the most part, these tenants are somewhat similar in that they're smaller retailers focused on either clothing or things like supplements that fit in a small retail environment in malls and so forth. So I kind of just fear that these spaces might become quite obsolete in the short to medium term if RioCan isn't able to revamp them or do something productive with those spaces, and for this reason this could have a negative impact on the overall net fair value of their portfolio for years to come if they can't do something strategic with those spaces. But this actually brings me into the next point, which is the management of RioCan. Based on this document as well as other research I've done on the company, RioCan's management seems very competent and well aware of the current realities surrounding their business model as well as the shift towards e-commerce. This earnings document has made it very clear that management will be looking to reassess their future expansion activities and revitalizing their current properties in a way that will move with future market trends. For those of you wondering what the current state of the dividend distributions are, even though the yield is subsequently quite high, well, currently the management has indicated that they are not planning on cutting the dividend. This means that at an almost 10% current dividend yield, you'll be receiving a very nice return on investment for years to come, or at least until further news is announced about the dividend. And finally, what do I think think about the current share price of RioCan? Well, since we last spoke about this company a couple of months back, the share price has trended sideways, and until we see further positive news about the medical situation as a whole, as well as business operations in general being on a positive note, I wouldn't surprise me if we continue seeing the share price trending relatively sideways for months and even potentially years to come. This is definitely more of a dividend play right now, but regardless, if we quickly calculate a projected price to FFO, taking the current price of roughly $14.90 per share and dividing that by the FFO per share of $1.60 projected for the rest of 2020, we get a price to FFO of around 9, which is still under the REIT industry average price to FFO of around 14 to 15x, and over time this should be reflected in the share price. My thoughts about RioCan have changed slightly since last quarter, where revenues were still quite strong and the effects of this whole medical situation were not yet seen in the company's overall income statement. Now, I do think that this is still a great dividend play for pretty much any portfolio, especially considering the fact that management has indicated that they do not plan on cutting the dividend anytime soon. So right now, at an almost 10% dividend yield, this is great. And I do also think that as the trust does continue expanding their operations and focusing on other aspects of real estate over the coming years, as the trust does adapt to new market realities, I do think that share price will be reflected here. I just want everyone watching this right now to be aware of the fact that this whole medical issue has exposed a certain reality for RioCan in that their portfolio is retail focused, and this has just kind of accelerated the overall mentality that e-commerce is taking a larger portion of commerce in general, and that this might be accelerated due to the fact that more people are looking to shop online right now. My final thoughts for this video is that considering current market environment as well as the state of this company and their portfolio mix, I do think that it might take several years to return to pre-crash highs. However, during that time frame, you will be benefiting from great dividend income, and over time you should see some nice appreciation in share price. As always though, make sure to do your own research about RioCan in order to see if this would be a potential nice fit for your specific portfolio and your needs as an investor. I really hope you enjoyed this analysis video, and that even though it was quite long and in-depth, you made it to the end because the value was brought to the table. So if you did enjoy the video, please make sure to drop a like and subscribe to the channel if you're interested in other stock market related as well as company analysis videos in the near future. Also, feel free to leave a comment down below letting me know what your thoughts are on RioCan moving into Q4. On that note, thanks a lot for watching today's video, and I'll see you in the next one.